If you make more than $200,000 a year and you want to reduce your taxes, this video is for you. It's 2025 and taxes are front of mind as you're getting all your documents ready to prepare your tax return. And every year, that looming tax bill, it's painful and it might even be a little scary. While it might be too late to reduce your 2024 taxes, it is a perfect time to go ahead and get ahead of your 2025 taxes. And that's what we do to help clients at our firm by proactively implementing tax strategies throughout the year so that they feel confident going into tax season. So in this video, I'm going to explain 5 tax strategies that you can use in 2025 to reduce your taxes. Let's dive in. The first thing to know about the Internal Revenue Code is that it's not very tax advantageous to be a W-2 earner. And so as you earn more money, you're going to want to start thinking about how to invest that money and snowball your wealth as tax efficiently as possible. I'm getting a little ahead of myself, so let's go ahead and dive into strategy number 1. The first strategy is super simple. It's max out your retirement accounts and your HSAs. Contributing to your retirement account and an HSA is a great way to reduce your taxable income because it can be done on autopilot. Tax strategies range in the effort that it takes to implement, and this is super easy. Additionally, your company might even match your contributions, which is effectively tax-free money. So make sure that you contribute at least enough to get that match and you're not leaving any money on the table. Money in your retirement account and your HSAs grows tax-free, and you only pay taxes when you distribute the money to yourself at some future point. It's a great way to build a retirement nest egg and avoid some taxes today. Now let's talk about strategy number 2. For strategy number 2, you're going to utilize something known as a backdoor Roth contribution. If you make over $146,000 a year and you're single, or $230,000 a year and you're married filing joint, you cannot contribute directly to a Roth IRA. And that stinks because Roth IRAs are incredible tax vehicles. Once the money's in the account, the additional earnings grow tax-free. A way to get around these income limits is to first make a non-deductible contribution to a traditional IRA. There are no income limits to making non-deductible contributions to traditional IRAs because you don't get a tax deduction for it. Once the money's in the traditional IRA, you then roll it over into a Roth IRA, and bam, you now have money in a Roth IRA even though you earn too much to contribute directly to the Roth IRA. Now there are some caveats to the backdoor Roth IRA. The first is the aggregation rule. If you have other traditional IRA accounts, your rollover to the Roth IRA will be ineffective. The second issue is the step transaction doctrine that allows the IRS to unwind a series of steps that were clearly meant to avoid tax and had no other purpose. Good professionals can help you work through both of these issues, so make sure that you're working with one. Now let's talk about strategy number 3. Strategy number 3 is my favorite. It's just to invest in real estate. Real estate investors take on huge risk by placing a lot of capital into buildings, and they hope to see a future return, but they also reap the tax benefits during the ownership period. Real estate investors can write off all expenses to maintain a property, like cleaning, repairs, property management, mortgage interest, property taxes, and insurance, and I'm running out of fingers, but they also get a special write-off called depreciation, which is a Vantum expense. And it's called a Vantum expense because depreciation is calculated by taking the purchase price less the cost of land divided by 27.5 years. So for example, if I purchased a rental for $500,000 and the land was worth $100,000, then my annual depreciation expense is calculated by taking $400,000 divided by 27.5 years, which equals $14,545 per year. So that's an additional $14,545 that I get to write off every single year against my rental income. And so if I have a rental that cash flows $10,000, but I have this depreciation deduction of $14,545, I get to tell the IRS that I lost $4,545 even though $10,000 actually hit my pocket. If you own 10 of these rentals, you could see how this becomes a pretty incredible stream of income that you don't have to pay tax on today, but it gets even better because remember, I told the IRS that I had a $4,545 tax loss. I might be able to use that tax loss to offset my W-2 income, which leads me to strategy number 4. Strategy number 4 is the passive loss allowance rule. If your modified adjusted gross income, or MAGI for short, is less than $100K, then you can claim up to $25,000 of losses from passive activities, such as your rental. You have to own at least 10% of the passive activity, and you have to actively participate in the management of the passive activity. But that $25,000 loss starts to phase out as your modified adjusted gross income increases above $100,000, and it gets completely phased out once your modified adjusted gross income reaches $150,000. So this is really only effective for people who earn less than $150K. But if your income's higher than that, here's another idea for you. Strategy number 5 is to qualify as a real estate professional. The Internal Revenue Code has a special carve out for people who spend a lot of time managing their rentals, and it's called real estate professional status. To qualify as a real estate professional, you need to spend 750 hours in real estate and more time in real estate than you do at your day job. So if you work full time, you can't qualify, sorry to say. But many of our clients have their spouses qualify when their spouse stays at home or works a part-time job. Qualifying as a real estate pro and materially participating in your rentals allows you to use your rental losses to offset your other income, like your W-2 income or your business income. If you can't qualify as a real estate pro, your rental losses will be passive and they will be suspended and carried forward year over year over year. So qualifying as a real estate pro is a great unlock for real estate investors, especially in years that they are actively buying properties, because in a year that you buy a property, you can create large paper losses thanks to something called bonus depreciation, which results from something called a cost segregation study. And the losses I'm talking about can be substantial, like 6-figure tax losses that you can use to offset your ordinary income and save you a ton of money in taxes. But if you're working a full-time job and you can't qualify as a real estate pro, here's a bonus tip for you. Bonus tip number 1 is to buy short-term rentals. The Internal Revenue Code also has a special carve-out for short-term rental owners. If your short-term rental has an average period of customer use of 7 days or less, and you materially participate in the rental, then your short-term rental is considered non-passive. And that means that you can enjoy the same benefits of creating large paper losses from bonus depreciation and offsetting your regular income without having to worry about the hurdle of working more in real estate than you do anywhere else. Many of our clients execute this strategy every single year, and we often see high 5 figures and sometimes even 6 figures of tax savings. It's pretty incredible. Another bonus strategy for you, and one that the ultra wealthy people use all the time to avoid taxes, is using debt to fund acquisitions rather than selling assets. When you sell an asset, whether it be real estate or stocks, you likely have large gains that you need to pay taxes on. But if you instead place debt on your assets and receive a check for the proceeds, like a margin loan or a cash out refinance, the debt proceeds are not taxable. So you can keep your assets, you get the cash to go buy new assets, and you don't pay taxes on the cash that you receive. If you have any questions regarding these strategies, feel free to schedule a free consultation with my team, which you can access below in the description. We work with thousands of real estate clients across the United States, and we have found most people switch accountants because they aren't getting any proactive advice from their CPA. We meet with clients several times a year, and we build customized tax plans based on your current income streams, assets, and goals. And we're very effective at helping clients reduce taxes. My name is Brandon Hall, and I'm the CEO of Hall CPA. I hope you enjoyed this video, and I'll know you did if you can do something for me. Comment, like, and subscribe to the channel. I'll see you next time.